This question looks at business valuations. It's a 25-mark question, and you can start off by multiplying the mark allocation by 1.95 minutes per mark to work out how long you're going to spend on each technical requirement. You'll see that the marks are split reasonably evenly between discussion in part A and C and calculations in part B and in part C too. The professional marks cover analysis, evaluation, skepticism and commercial acumen, and are just encouraging you to do things that you should do anyway in a good technical answer. You should be objective, you should use the numbers, you should use the right approach to the numbers. You should look at the impact of things that you're a bit dubious about. And you should make sure that the points that you're making are commercially realistic. To make sure that your points are relevant to the requirements and to the scenario, you'll need to invest in some reading time. Generally, we would say about 20% of the time available will be for reading, planning, understanding the requirement. Now, obviously, I'm going to assume that you've done that. I'm not going to read through the question with you. We're just going to focus on some of the key points. So in part A, I'd be copying the requirement into my plan, and I'd make sure I've answered both parts of the question. Discuss the different sorts of synergy. Well, I'm not going to write the answer out for that, but that is simply explaining what is meant by sales synergy, cost synergy, financial synergy, that sort of thing. And you'll get a couple of marks for that. And then discussing the possible sources of revenue synergy, well, that's very much focused on this scenario, and that's harder. There are 4 marks available for it. It'd be nice to get a couple of them. And we're going to get a mark a point. So, what are we going to be drawing on here? Well, just the idea that we're a company that's involved in a particular business, and we're looking to move into an area that we have limited experience of. So just that one point, it's going to be difficult to see how we're going to sell more in the biotech industry because we're not in that industry. However, what we're good at is getting products to market quickly. That might matter in biotechnology, where product life cycles might be quite short. We've got significant cash reserves. That might help with product development, which we know could help Strandco because Strandco are constrained by the lack of funds. So we're going to have full sentences. We're going to be making some basic points here. And I think that the question says to discuss, and discuss is really an invitation to look at different viewpoints. And in doing so, to come up with a good professional answer, earning professional skills marks too. And you might conclude that there is some scope for sales synergy, but it's held back by our lack of experience. Now we're going to focus on parts B and C, which is where we've got some calculations to do. So moving into part B asks you to look at the 2 different opinions expressed about valuation and to calculate the maximum acquisition premium payable. So because I'm being asked to work out a premium, logical question is on what? Well, that will be on the current value. So let's start off by looking at the current values, and then we're going to focus on the methods of valuation which we're told about in the question and do our best with them. We're not going to get a perfect answer. It's not necessary. Part B is the hard bit of the question. It would be great to escape with 4 of the 7 marks and then to do better on part C and to pick up professional marks too. So our starting point is, what is this company currently worth? It's a logical starting point and it will pick up a couple of marks. So you're going to show neat calculations that the marker can follow. You're going to use workings where you think it's necessary. And sometimes you're not going to use workings, you're just going to put the numbers into the cell. So to work out how much HAV is worth, well, the question tells me that HAV has $600 million nominal value, 25 cents is the nominal value per share. And the share price, we're told in the question, is currently $9.24. And I think that's reasonably clear to the marker. I might add a small amount of narrative underneath as I have done here. And then for Strand, it's harder to work out what Strand's currently worth because the question says that Strand is currently worth 10% above the current average PE ratio, which we're told is 16.4 in the biotech sector. And Strand's earnings, okay, so earnings are going to be after tax. Well, I'm going to take the latest year, which is 397, but that's before tax in the question. So I'm going to multiply by 1 minus the tax rate. The tax rate given in the question is 20%, and that gives me 317.6. So that's going to be a current valuation of P ratio times earnings, which is 5729.5. There are some slight rounding differences in the solution, which uses a P ratio of 18 exactly. Obviously, that doesn't matter. So this is our starting point. HAV is worth 22176. Strand we think is worth just over 5729, and add the two numbers together, and that's where we start from. Now let's look at the valuation approaches that we're given in the question, and they're both sort of dealing with intangibles. So again, I'm going to try and make this as clear for the market as I can. HAV's view is that we should be using earnings and PE ratios. So the earnings figure is given in the question as 1980, but that's before tax. So again, I'm going to multiply it by 1 minus the tax rate. Strand's earnings I've just calculated up here, and we've got some synergy that's already after tax. And so I can add those together, and it gives me a valuation of just over 2,000 million. Which PE ratio to use? Well, the question says that the PE ratio of the combined company will be 14.5. So 14.5 times the earnings gives me a post-acquisition valuation. Now, if that's what we're worth after the acquisition, and at the top of the screen, 27905.5, that's what we're worth before, then the maximum we should pay is the difference between those two numbers. And that's 1697.7. And as a percent of Strand's value is calculated at the top of the screen, just over 5729. So as a percent of that value, 1697.7, well, that's 29.6% of Strand's current value. That's the maximum we could possibly pay extra using the earnings basis. And then using Strand's approach, the second approach, this set of calculations is a bit more unusual, but the instructions are given in the question. We have to work out the premium payable on acquisition based on the present value to infinity of the excess earnings after tax the company has generated over the average return on capital employed on the biotech industry. So the information that we're given gives us the assets of Strand. So I've got the non-current liabilities, which fortunately are the same in each year. And then I've got the equity. So for each year, I'm going to add up these numbers, and that gives me the capital. So in 20x3, that's 483 plus 400, and the same calculation in the other 2 years. I'm going to add them up. I'm going to divide by 3. That's going to give me my average capital. And then my average earnings, well, I'm going to add these up, divide by 3, and they're before tax. So I'm going to multiply them by 1 minus t. So let's look at that. Okay, so the average capital employed, I'm just going to take the numbers as I suggested. So 883, 88866 and 859, that's the capital employed in the 3 years. To work out the average, I divide by 3. That gives me 869.3. The expected return, we're told, is 20%. And then to work out the excess returns, I'm going to take the 3 years of actual earnings given in the question. You can see at the top of the screen, that's 397, 370 and 352 divided by 3. That's before tax. But the expected return of 20% was before tax as well. So taking that excess return of 199.1 after tax, multiplied by 1 minus the tax rate, That gives me 159.3. Discounting that to infinity times 1 over the cost of capital, or just divide by the cost of capital of 7%, and that gives me a value of 2275.8. As a percent of Strand's current value, which I had at the top of the screen, of 5729.5, this is suggesting that the maximum that we could offer is a very high number, representing approximately 40% of Strand's current value. So that's a slightly unusual valuation technique. You need a clear set of workings, and the marker can follow what you're doing and award you marks for what you get correct. And then in the final part of the question, we have to calculate the premium that Strand shareholders would receive under a couple of different acquisition payment methods, and then justify which payment would be most acceptable to Strand. Okay, and we're given the details at the end of the question. Here they are. We've got a cash offer and we've got a convertible bond. Right, so let's have a look at this. For the cash offer, we have to say what's that as a percent premium, and is it likely to be acceptable? So let's look at that. Okay, so to understand what premium the cash bid of 572 represents, we need to value Strand currently. And of course, we've already done that. I'm going to show it as a working, but we already did it in part B. So in part B, we said Strand was worth 5729.5, and that was in millions. So that was from part B. And we know that Strand from the question has got 300 million of ordinary share capital, and we know that the ordinary share capital has got a nominal value of 25 cents. So it represents 1,200 shares, 1,200 million shares. And so the share price for Strand currently is the total value divided by the number of shares. So that's about 477. So putting in Strand's current value of 477 gives me a premium of about 20%. That's what the cash bid represents. And I'm going to discuss that. I'll do that in a second. But before I do, I just want to have a look at the other part of the bid, which involves a convertible bond as well as cash. And in my workings for this, I would be showing that the $100 nominal value, for every $5 nominal value is 25 cents. So that's for every 20 shares, 5 divided by 0.25. I'm being offered $100 of convertible debt. So simplistically, that is $5 per share. However, it could be worth a lot more than that, depending on what the share price is in 6 years' time. But it seems likely to be worth more than 100. But I can do a basic valuation using these numbers. So I've got the cash of 125 and the convertible worth maybe 5, probably more. Add those together, it's worth 625. Compared to Strand's current value of $4.77 gives a premium of about 31%. So what does all this mean? Well, I'm going to get 3 marks for discussing, and my discussion must be in the word processing software, not in the spreadsheet. Must be in word processing. But I'm just going to put in a couple of the points here. Strand are likely to go for the higher value. It is riskier, but not that much riskier, because that convertible debt presumably isn't going to fluctuate quite as much as a share would. But it could be much higher if in 6 years' time the share price is high and you convert into shares. Reflecting on the calculations in part B, it is close to the maximum, depending on which approach you're going to go for. It's close to the maximum that we can possibly pay for Strand. So in my discussion, I would say Strand shareholders, I think they would go for that second offer. Whether we should be offering it is a different question, because it's very close to the calculations in part B. Now, just reflecting briefly on the professional marks. Analysis and evaluation is about how you've approached the problem. Have you done the right sort of calculations? And then when you've got the numbers, Has it fed into your discussion? So did you use what you did in part B to help inform your discussion in part C? To pick up marks for skepticism, well, we could talk about the problems of some of the techniques used in part B. We could talk about the impact of the valuation of the convertible. Now, to get the skepticism mark, we're not going to say just that the $100 assumed value of the convertible could well be wrong, but we could talk about the impact of it being worth more if the share price goes up. And if it's worth more, it means that we're offering Strand a really very attractive deal, which they would definitely go for. So to get the skepticism mark, you have to explain what you're skeptical about and what's the impact of that assumption. And then for commercial acumen, well, this is all about making points that are realistic. And a key place for doing this is discussing sales synergy. So this is where we are trying to make practical points by using the scenario and explaining using the details in the scenario whether or not we think revenue synergy is likely to happen. And that completes this short debrief.